sometimes it can feel like an individual stock is just out to get you. Nearly 6 months ago, I told you to stay away from Align Technology. That's the maker of Invisalign, incredible see-through braces. As much as I love the product, I was worried about newfound competition. I thought the stock was too risky. Then I watched with horror as Align shares, they caught fire, rallying from the mid-240s to a peak of 334 a couple months ago. That was when I made my second mistake. I gave up on my sell call. I told you I've been wrong. I apologize. Wow. Jinx, snake bit. But maybe we were just early. When Align reported its latest results last night, the company delivered a seemingly strong quarter, a big earnings beat paired with a more modest revenue beat. However, management's guidance for the next quarter was far lower than expected, and their full-year commentary was even more discouraging. They previously predicted 20 to 30% revenue growth this year. Now they're saying it could come in as the low end of that target. Because this is a high-flying stock, one of the best performers from when the S&P went from 2,000 to 3,000, it got obliterated, down $74, 27% today. So what do we do with Align here? Is this a broken stock that can bounce back, or is it a broken company? Let's check in with Joe Hogan. He's the president and CEO of Align Technologies. Learn more about the quarter and why he's now guiding for a slowdown in the second half. Mr. Hogan, welcome back to Mad Money.
Hi, Jim. Thanks for having me back. I appreciate it.
All right, Joe, when I see a stock get clocked like this, and I have an executive on, I give you the floor to tell us why the stock might be wrong, because I think it is. I think to you.
Yeah, Jim, I'd broadly say this is about China. Remember, if you look at the quarter, we had terrific growth. We had overall international growth in Europe of about 39%, in APAC, about 34% overall, but China's our second biggest country in the world. We were expecting about 70% growth out of China, and we achieved about 20 to 30%. And that was broadly the miss from an aligner standpoint in a quarter. And it's not a competitive issue, Jim. It's not an operational issue at all. It's just basically a consumer backlash right now, we feel, from a standpoint of making decisions on going ahead with aligners or not. So it was broadly a China miss. I'm still optimistic about the market in general and what's in front of us from a growth standpoint.
Well, let me follow through on that. Estee Lauder's got a gigantic Chinese business. Obviously, that involves looking good, okay? Align involves looking good.
Yes.
Their Chinese numbers were extraordinarily strong. So I know you dismissed the competition, but there is a competitive outfit in China, Angel Line. Are they taking share?
You know, I was just over in Asia last week, so I was with my sales team there, Jim. We don't feel that there's any share shift changes between Angel and us. It continues to be, good competition, but no movement either way from overall share. Well, we feel we're at the higher end of the marketplace, the higher end consumer side. In the specific areas of China is where we felt this.
Okay, now you did say in the call, you kind of showed some leg that July might be a little bit better. I was wondering whether that's U.S. and China or just U.S.
No, it's actually U.S. and China, Jim. So as we've rolled into July, we've seen stronger orders out of China. We've also seen stronger orders out of North America, too. Jim, we're broadly going into teen season. So it's teen season in China and teen season, also in North America. And that demographic's a little different. We think it's less price selective because these kids are slated or teens are slated to have these treatments, and the parents want to meet that time frame.
All right, well, let's talk about price selective. We went on to the web and took a look at Smile Direct Club, a competitor you guys know better than anybody, and they had some pretty low pricing, $1,895, $1,895, or $85 a month. And when I read this, I start thinking, geez, maybe these direct-to-the-consumer competitors have tipped a tipping point where they are now much more powerful than they used to be.
Jim, this is a different part of the marketplace, and it's a different model altogether. Remember, we're only 10% penetrated in a broader orthodontic market, which is broadly teens or whatever. We have a huge amount of growth there. Smile Direct Club competes in the low end. They have a viable product line or whatever, but it's an area where we have product and we can compete through our doctor channel. So, overall, Jim, I feel like we have a good position, versus them in our doctor model in treating patients rather than going direct.
All right, how about these dental service organizations? I mean, the bears on your stock have told me that between, say, Danaher, Shine, 3M, that they all come in and they get these dental service organizations to compete against. They bargain and then you get hurt. But on the call, you don't think that they're a bad influence on your pricing.
No, we don't. What we do is we don't sell what I call comprehensive products to our DSO partners. And we work really closely with them on certain product lines that fit in that area. And honestly, those dental service organizations, I call them force multipliers for us. We have a unique product line and a unique package. It's hard to duplicate in that sense. And the hygienist chairs are where you see a lot of these patients and where we want to be able to use our visualization technology and iTero scanners that were up 80% in the quarter to be able to show patients, how their teeth look, after the orthodontic procedure.
Okay, so Joe, I've listened to every single one of the things you say, and now I come back and I say this. All right, you've got $765 million of cash and cash equivalents, marketable securities. You've got 183 is overseas, but there's 582 million that's right here. You bought back only 161,000 shares in the last quarter. Why not take 280, take half of it, and just go into the open market and buy, one, knowing what July is doing, and two, knowing that the Chinese can't possibly stay away from this for too long, given the fact that they are fascinated by a line?
Well, Jim, we are positioned well right now. We have $400 million left on what we're allocated right now from a stock buyback standpoint. We'll certainly take advantage of that.
So you will be in. How about you personally, Joe? I mean, you're an aggressive guy, but you love your product. I know you do. Is this the opportunity that someone like a Joe Hogan says, I know this is an overreaction, I'm in?
Yeah, I think you'll see that also, Jim. I do. Because, Jim, I just want to emphasize a few things. Look at this business overall. We grew 39% in Europe, 50% in France, 50% in Spain, 35% in the UK. Japan, we grew 50%, Taiwan 70%. Brazil, we're over 100%. I mean, there's a broad-based growth story here that I have to do a better job and the company has to do a better job of getting out. It's not necessarily a competitive story. It's an opportunity story for us overall.
And it remains something that the dentists know they need in order to be able to make a good living, doesn't it?
Absolutely. I mean, the idea that dentists aren't straightening teeth in some manner is kind of difficult to believe. But dentists and orthodontists can survive together by orthodontists doing the difficult patients and dentists doing the less severe cases. It's the way I think it works really well, Jim.
Well, I'm so glad you came on the show. You don't shy away from anything. There'll be other executives who say, you know what, this is a bad day to come out. It's a good day to come out. I want to thank Joe Hogan, President and CEO of Align Technology. Sir, great to see you.
Thanks, Jim. You too.
I like a guy who says he's buying stock, or hints about it, but certainly buying back stock and maybe buying stock himself in the open market. Maybe this one comes back. I was wrong last time. I'm jinxed. You got to make the decision. Mad Money's back into the break.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Kramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.